go ahead and call the meeting to order. It's November 15th. This is our pension committee meeting. Our first item on the agenda is public comment on any actionable agenda items. Frida, did we have anybody sign up this morning?
No, ma'am.
Okay. Our next item is to consider the minutes of our August 16th, 2023 meeting. Any changes? No changes. Is there a motion to approve?
Move that they accept the minutes as stated.
Second.
All right. I'm sorry. Frida, can you call the roll?
Yes. Justin Burris.
Here.
Earl Hall.
Here.
Kathy Smith.
Aye.
Karen Tucker.
Aye. Okay. Next we have Amy Kraus of Cowden and Associates. She's going to review our actuarial report for the year ending June 30, 2023. This report goes into our audit report. So we'd like for the pension committee to get that information. We expect the audit report to be finalized hopefully later next month. So Amy, welcome. This is your first time presenting this report to the committee, so welcome.
Thanks, Jennifer, and good morning to everyone. Happy to join you this morning. And so in your packets, there is what's called the GASB 68 disclosure information for the pension plan. And under GASB 68, you can use measurement dates that are different from your fiscal year end. So the city's fiscal year end was June 30th of 2023, and the GASB 68 reporting, the measurement date is actually 1 year prior. So the information that is within this report is a 1 year lag from that. And it's really a review of what happened from July 1, 2021 through June 30th of 2022. And so when we took over the actuarial work, one of the first things that we did was look at your prior actuaries' measurements of the pension plan, and we valued them independently to see how close we could get to them and whether or not we could do a reasonable transition. And so on the second page of the letter, we addressed that in right under where it says change in actuary. We state that we were able to match the prior actuary within 2%. And really, in any actuarial transition, our goal is to be within 5%. You know, some of the variation could be in the programming software that one actuary uses versus another. You know, different rounding techniques, those types of things. And then as we move forward, you know, there might be different assumption changes or things that we do a little differently than the prior actuary. But overall, for this pension plan, we were able to get very close to the prior actuary, which is a good thing. And so because of the 1 year lag in the GASB 68 reporting, the city has already used what USI had prepared as of July 1st, 2022 on the funding side of things. And so for employer accounting reporting, what we did is we took what USI had measured as far as liabilities go, and then we took the audited assets that were reported last year in your financial report, and then we put those together here because we had a good enough transition to be able to do that and rely on those measurements. And so if we turn, if you turn to page 2 of 13, so it's Exhibit B, it says changes in net pension liability and total pension plan. So again, this is looking at what happened from June 30, 2021 to June 30, 2022. And the two big items that, you know, kind of drove the show here was on the liability side, which is that column A. You see the fourth entry down, it says differences between expected and actual experience. And there was a loss of $7.6 million. And that was part of the reason why on the liability side, liabilities increased from $190 million to $207 million. On the other side of the equation is column B, that's the assets. And on the asset side, during that time period, which I know this isn't new news to you, during that time period, there was an investment loss of about $21 million. And so instead of the fund earning the assumed 7% return during that period, there was actually a negative return. Again, this is all what has happened in the past. The markets have changed a lot since then, and I know your investment advisor is on the meeting today too, and she'll give you what's happening today. But overall, the net pension liability, which is just the liability minus the assets, went from a $12.8 million net pension liability to a $52.2 million net pension liability, meaning the liabilities continued to grow during that period, but on the asset side, we actually had loss. And so the city at this measurement date was in a worse funded position. That's kind of the main driver of what the results are showing. And again, this is, over a year old, the information that we're reporting on here. As we look forward, the expense that you're going to be recognizing for this year, you can turn to page 9 of 13 in that report. So this breaks it out between the two groups and then shows a total. And so for the fiscal year ended 6/30/2023, you'll be recognizing a pension expense of about $9.8 million. Compared to your prior year, the pension expense that you recognized was about $2.7 million. Okay, and again, the main drivers behind those were the investment loss and then the experience loss. And so with accounting measurements, you have to recognize those gains and losses over a period of time. And that was what was displayed on the 3 pages prior to this. It shows how those are recognized over a set number of years. And so those larger losses, on the investment side, you have $6.7 million to recognize each year in your expense. But again, the year prior, you actually had a larger investment gain, and so you're still recognizing part of that gain through your expense as well. But that's the big driver as to why the expense that you're recognizing increased so much from just that 1 year. And then going forward, Cowden Associates, we will relook and remeasure the pension plan as of July 1st of this year, and that will determine your funding going forward and be the basis of next year's financial disclosure. So I'll pause and see if there's any questions.
Y'all have any questions? So this updated report is what we'll use for this year's audit report, correct?
Correct.
Okay. And then when do you expect the annual valuation report to be done that tells us what our contribution rate will be as a percentage of payroll?
I anticipate having that done no later than February. I'm trying to get it done sooner than that, but February is kind of the very end date of when we would get that together.
Okay. Yeah, we'll be starting budget projections. Usually, we start that in late January or early February, so that would be great if we could get that by then.
Okay, and I do know that this year, the timing of some things were more delayed with the transition, and so moving forward, kind of after we get this initial year under our belt, the timing of everything should move forward.
Great. Okay. Well, I know it's been a rocky market, for our pension plan, so I know a lot has changed, like Amy said, in the last year, so we'll be hearing from Natalka in just a minute about that. Are there any other questions? Jennifer or Austin, did y'all have any questions or anything to add to what Amy just said?
One question I would ask is, how does that, without revealing, to other pension plans that you manage, how does that measure up? Are we in line? I mean, it was a wild time in the markets, a disappointing time in the markets, but how did we stand up against other municipalities that have a pension plan similar to this?
I think that this has been a pretty common story, having the 1 year of high market returns and then followed by a year where it dipped back down. There's just a lot of volatility with what's going on, across the world right now. So this is not surprising to me based on what I've seen in other plans. And the market is cyclical. You'll have ups and downs, and that's why, when we're looking from an actuarial perspective on this pension plan, we're really focused on long-term, holding out, where are we going, not having a knee-jerk reaction to any individual year in the market. So there's nothing surprising from the results from my perspective.
And so also you'd said something earlier, it made me think about this. We do a 5-year smoothing, right? So that spreads out those, and big gains in 1 year and big losses, in another year. Is that a good way to explain that, Amy?
So that would be on the funding side.
Okay.
On the accounting side, you're going to recognize the market value
Right.
of your assets. And so that's why on the market side, your funded status, that net pension liability, is going to be a little bit more volatile. And then as far as you recognizing it through expense, there's a smoothing piece of that. So your
Right.
individual year's expense, the investment gain or loss, has a 5-year recognition. But as far as the net pension liability, that funded status for accounting, that's going to be tied to the market.
But that way, we're not shooting, really high 1 year on our contribution rate and then low the next.
Correct. Yep.
Okay. Well, I don't see any other questions or comments, Amy, so thank you very much for this review, and you're welcome to stay on and listen to Natalka's presentation. Natalka, are you ready to go ahead and discuss our third quarter and October plan performance and flash reports?
I am. Nice to meet you, Amy, and good morning to the rest of the committee. And my associate, Chris Rollins, is going to start off the meeting. And it was, in many ways, timely to have Amy's presentation because at Fiducian, we have a fiduciary governance calendar where we take a look at what I'll call some non-performance related aspects of your plan on a quarterly basis to just help you better manage the plan and employ sort of best practices from a fiduciary standpoint. And for the third quarter, it's sort of a review of the municipal landscape. So Chris will have some comments as to how other municipal plans are doing from a funded status and actuarial status, and also has some top-level comments on the previous actuaries report through July 22nd. So, Chris, would you like to start off with some of those comments?
Yeah, great. Thank you, Natalka. Good morning, everybody. In terms of our third quarter report, I'm on page 4. The title of that slide is Fiduciary Governance Calendar, and as Natalka pointed out, just looking at really the optics and the cadence of that governance calendar, we think there are some items as stewards of the public plan that you should be aware of throughout the year to help you make informed decisions. In the first quarter, as you can see, it's a fee focus. We think it's important to really bring about all the fee transparency and the liquidity profile of the plan. The second quarter, you can see, is practice and policy, right? That's where we review the investment policy statement. And, we often get the question, right, from stewards overseeing public plan assets that, hey, we're not governed by ERISA, but what should we be doing throughout the year in terms of carrying out our responsibilities? And most states have a Prudent Investor Act, which talks about duty of prudence and duty to diversify. And so we talk a little bit about fiduciary trading. And then Natalka pointed out rather timely, this quarter is a focus on the municipal landscape. So it gives you a sense, I think there was a question, well, what are other plans doing around maybe their funded status and discount rate? And it's really timely for the annual actuarial review. So we like to have an open communication with the actuary for a couple of reasons. One is we want to understand the liability side of the equation. And we want to look at some of the assumptions that are being used. And that kind of dovetails with the fourth quarter, right? So if we know kind of what's going on the liability side with respect to cash flows, with respect to some of the assumptions, that may influence our thinking around asset allocation. So you may recall over the years, discount rates, the investment return assumptions for public plans have come down as a byproduct of a very low interest rate environment. Well, how does that influence thinking around asset allocation? Should asset allocations become more conservative? Or do we hold our ground because maybe we recognize that yields at the time weren't as strong as they are today? So looking forward to the fourth quarter, what we're going to do at Fiducian is run our capital market assumptions. These are our 20-year outlooks on the markets, and then just kind of re-underrate the asset allocation just to make sure and reaffirm that asset allocation aligns with your discount rate. And I think if there's a bright spot to the kind of bond market carnage we've been experiencing over the last 18 months or so is the restoration of higher yields. So an asset allocation setting like a pension plan or even a foundation or endowment as an example that relies on fixed income to provide that ballast within a portfolio, the yields on fixed income, higher yields are a good thing. We want to embrace that. So going forward, we think there could be an opportunity to temper risk in the portfolio over time as yields move higher. That has not been the case over the last 15 years. Portfolios actually have gotten more aggressive even though discount rates have come down. So if I could turn to page 6, there was a question earlier, right? Trends in funded status. So we do get that question, right? Now, what's going on with other public plans? And we use sort of Milliman's 100 largest U.S. public plans benchmark as kind of an index to what other public plans are doing in terms of the funded ratios. And as reported by Milliman, as of the most recent fiscal year, now you don't have these numbers as of June 30th, was about 75.8%. And that was a slight uptick at the end of 2022 because this fiscal year ending 6/30 was actually not too bad. Your plan actually returned 7.6%. for this fiscal year, and that's going to represent an actuarial gain, so that's going to be favorable. But you can just see the outcomes. About 60% of plans have funded ratios between 60 and 90%, and then 23% of those plans, as reported, have funded ratios that are lower than 60%. So it's kind of a little bit all over the board, but just gives you a sense where, on average, you're looking at about 75.8% at the end of this June, but about 74% at the end of last year. The other slide is on page 7, and this is, really trends in investment assumptions, right? So over the last several years, plans have reduced the discount rates, and your plan is no different, right? You've reduced your discount rate, or also known as your investment return assumption. And so what this slide just illustrates is going back, almost 20 years or so, the kind of distribution of investment returns back then was between 7 and 8.5, or greater than 8.5. If you fast forward to today, that distribution is between 6.5 and 7.5, where 7% is the median. So that gives you a really good sense of what plan's been doing around that discount rate, and it has become more conservative. I will say at this time, we are seeing that most plans are pausing on a go-forward basis to reducing the discount rate. And that's a byproduct of the restoration of higher yields in the markets and lackluster investment returns in calendar year 2022, as the actuary just pointed out. Because you have to be cognizant, anytime you reduce that discount rate, right, it results in a higher actuarial liability, and that could impact your ADAP, which is your actuarially determined employer contribution, and impact the funded ratio as well. So the takeaway of this slide is, yes, trend has been lowering the discount rate. We think there's going to be a pause given the restoration of higher yields and the lackluster results in 2022. So that's kind of the governance calendar this quarter is designed really just to give you some insight around public plans, funded statuses, and what they are doing along the lines of discount rate or investment return assumptions. Before we move out of the governance calendar, are there any questions from the committee at this time? And again, on a go-forward basis, we're going to continue to have that open dialogue with the actuary, because we really want to understand the liability side of the equation and how that influences our thinking with respect to asset allocation in the investment portfolio.
I don't see any questions. Sorry, I don't see any questions.
There's none, huh?
Yeah,
All right.
I'll sort of just make one closing comment on the municipal landscape. So Chris mentioned your fiscal year-to-date return, or your fiscal return for June 30th, 2023 was 7.6%. And, if we looked, we got some information on how other large pension plans did from a return perspective, and many municipal plans were, 5% or below for that same fiscal year period. So your plan did very well. I think that from an investment standpoint for the fiscal year June 30th, 2023, and I think that part of that is some of the larger plans invest in private equity and other private investments that did not fare as well and were marked to market a little bit lower. Some of the liquid strategies held up a little bit better. So, hopefully the June 30th numbers will improve, the funded status as well as the accounting status.
Absolutely. And Natalka, remind me, we were at 7.5% on our assumptions a few years ago, right? And then we reduced that down to we reduced it down, I think, to 6.5%, but brought it back up to 7% shortly after that.
Yes, so you're at 7% now from what we saw from the last USI report.
Right.
And if I could just add, within our book of public plans, the average, and that's about 120 plans, the average is about 6.5%, and the median's just slightly higher. So just to give you a sense of the marketplace for our clients, is that trend has come down. It's interesting. I've had several meetings this quarter, and given the restoration of much higher yields, there's a question from committee members like, okay, when can we increase the discount rate, right? So we've been lowering over the years, and I think our response and the actuary's response is that we're probably in the first or second inning of this new interest rate environment. We want to see how we settle in before discussion around changing the discount rate. So I just wanted to add a little insight there.
Absolutely.
Chris, if you don't mind, if I could jump in too, this is Amy again, the actuary. So a lot of what they're saying, this is the conversation that we're having with a lot of our clients. We definitely are seeing a pause where the trend was to lower and now there's a pause. And I just wanted to talk briefly about the request to increase the interest rate. So a lot of our conversations that we have with our clients is we're saying as you decrease that rate or you're at the current rate you are now because you've decreased it, we almost see it from a risk perspective. So if you keep it at 7% and not have to push it up to 7.5%, then Chris and Natalka, their team, they don't have to look at more risky investments. So by keeping it at 7%, then they don't have to look for these different alternatives. She mentioned private equity, private debts, those types of things that have more inherent risk in them. Where the pension plan is more steady, the benefit payments and things that will be coming out of them is a more long-term, steady type of investment that you're going for. So I just wanted to comment on that.
Yeah, Amy, if I could just add, I think you're absolutely right. And I think, plans over the years have had to be aggressive, whether they had a 6.5% or 7.5% discount rate, because you just couldn't harvest any return from fixed income. So to your point, you're absolutely right. They've had to take on global equity risk. They had to take on private equity or private real estate. I think the thinking going forward is, what role does fixed income play in the portfolio going forward now that yields are significantly higher, right? So before we had to rely on taking risk in other areas of the capital markets pretty meaningfully, with the restoration of higher yields, boy, that fixed income portfolio that we relied on to provide that income for so many years, which was absent, has now come back into favor. What role does that play going forward? So, again, I think this is an ongoing conversation. I think, the restoration of higher yields is a game changer, and is likely to continue to influence dialogue around asset allocation and around discount rates, over the next couple of years.
So, Chris, do you want to lead us into performance with, sort of a brief market recap for the Q3? Or I know that you have. Okay, that would be great.
I think so, right? I think we could turn to page 18 in the Fiducian report. This is the third quarter financial markets performance. And look, we've kind of been all over the board, right? I think there was a comment earlier, right? It's a difficult third quarter. October was pretty difficult. And now November has been lights out. We could talk about some of the numbers in November, right? The S&P in November alone is up over 7%. Small caps up 8.2%. REITs, which you have a meaningful allocation portfolio, are up 8% here in November. Fixed income is up 3 1/4 here in November. So November's been a game changer a little bit. But on page 18, let's get back to the third quarter results. You can see it was a difficult quarter. So we did have 3 solid quarters, which was great because that helped your fiscal year number. But as we got into the third quarter here, I think there was a concern that, we were looking at higher interest rates for longer, getting sort of this hawkish tone from the Fed. And you can see there was kind of no place to hide in the third quarter. The U.S. aggregate bond index was down 3.2% as yields spiked up pretty meaningfully. And on a year-to-date basis through the end of September, we were down about 1.2%. But just below that line item, you can see U.S. corporate high yield. High yield bonds were up actually 50 basis points and up 6% year to date. So high yield bonds are less sensitive to changes in interest rates and more sensitive to economic conditions and really kind of the health of corporate America. So what you're dealing with high yield bonds is more around default risk than interest rate risk. And I point that out because we do have a high yield allocation. And that high yield allocation has certainly paid off some pretty attractive benefits. Outside of fixed income, right? So fixed income returns were challenges. As you kind of get into global equities, the numbers were negative as well. So large caps sold off, held up a little bit better than small cap. On a year-to-date basis, you see YTD, growth style investing continues to meaningfully outperform value. So think about information technology and AI and those magnificent 7 stocks that have been leading this really concentrated market. Growth has been dominating value so far in 2023. As you get outside of the U.S. markets, returns were south as well. EFA index, which is the developed markets, were down 4%. But we're still positive on a year-to-date basis. And then emerging markets were down about 3% as we continue to see a good deal of weakness in China. China represents about 30% of that MSCI emerging markets index. Offsetting some of that weakness were good numbers in India. One thing to point out in the international markets, which is notably different than the U.S. markets, is the weighting of technology in these indices. So in the U.S., technology has a significant weighting, whereas in the international markets, it's much smaller, and financial sector has a greater weighting. So I did want to point that out. Lastly, I think on this page is to focus on real assets. Real assets were down about 2.6%, so really preserved principal better than other areas of the market. You'll see that the Bloomberg commodity total return was up 4.7%. That's because energy prices were up 30%. The energy sector was really the only positive sector during the quarter other than communication services. So energy sector was up about 12 or 13%. When you kind of wrap that up into a real assets framework, that was one of the better areas of the market. Even though it was negative, tended to hold up a little bit better. So kind of the takeaway before the topic gets into investment performance is a challenging third quarter, right, on higher interest rates for longer. That puts pressure on equity valuations. In October, kind of the same theme, right? And then we get here into November, we get a good print yesterday on inflation, and the markets were up 500 points. Bond yields came down, and November has just been lights out. So that's a brief recap of third quarter, and maybe I could turn over to Talcott to go through the portfolio in more detail.
Sure, thank you for that. I was going to say, if we want, we can just talk about November and not have to relive the third quarter, but that's sort of not the reality. But yes, if you go to page 20 in your performance reports, the page is titled Portfolio Dashboard. It's actually one of my favorite pages in the report because it provides you with a lot of information on your plan in a snapshot. So you everything from market values to performance to asset allocation. So in the upper right corner, the market value of the plan, as both equities and fixed income were in negative territory in the third quarter, not surprisingly, plan assets fell from $164.2 million to $59 million in the third quarter. There were $505,224 of net outflows from the plan, mainly benefit payments and other plan expenses, and there was $4.8 million of unrealized losses in the third quarter. If you go to the left side of that page, we see performance. So for the quarter, the plan slightly, virtually matched within about 10 basis points the drop in the market. The plan was down 2.9% versus 2.8% for your blended target index. On a year-to-date basis, the plan is still slightly ahead of the benchmark, up 3.3 versus 3.1%. I'm going to go into asset allocation now, but we'll come back and we'll revisit performance of your investment teams in a few minutes. But from an asset allocation standpoint, there was a lot of activity in the month of September, a lot of rebalancing that was done in preparation for funding a new core bond manager to add to your fixed income team, Baird Aggregate. The actual funding of Baird did not happen until October 3rd and 4th. But there was a lot of money being raised and moved from other asset classes to initiate that funding. So if you go to page 23 of your report, it'll summarize the money movements that took place in September. From an asset allocation standpoint, at the end of September 30th, your plan remained underweight in fixed income, 28% versus 34%. Now, with the funding of Baird in October, that underweight to fixed income was reduced. At the end of October, you're actually at 30% in fixed income versus the 34% target. The funding of Baird did two things for your fixed income portfolio and for the plan. We reduced the underweight to bring you closer to target in fixed income. As Chris mentioned earlier, with fixed income yields higher, we're trying to position the portfolio to take advantage of some of those higher yields. And also, we're trying to improve the credit quality of the fixed income portfolio. Over the last 5 or 6 years, the plan has invested in multi-sector bond funds, in high-yield bond funds, in REITs, all in a search for yield. And now, with yields up a bit, we feel we can dial back on the credit issues and risk levels in fixed income, improve the credit quality, and give the plan, if you will, a more stable fixed income return profile. Also, at the end of September, your domestic equity allocation was overweight target, 34% versus 30%. And with the rebalancing, because we did take some money off of we trimmed some off overweight equities, that at the end of October, your domestic equity allocation was at 32.5%. International equity exposure is over target, 15.5 versus 12%. That includes 2 global equity managers, 1 international and 1 emerging markets manager. A little bit of those assets were trimmed as well. You're down to 15.2% at the end of October, so still overweight. Real assets, which includes your global REIT fund, 2 domestic REIT managers, and a commodities fund, was underweight target as of September 30th, 21 versus 23%. Commodities have done well for you this year. They've held up well. As Chris mentioned earlier, REITs have had a very challenged environment. They participated very strongly in November. Yesterday, they're up 5.5% in a day. We'll see if that holds. But we have decided, the committee decided to tactically underweight the reallocation towards the lower end of your target range during these challenging times. So some of the funding for the new bond manager also came out of REITs. Our allocation to real assets is down to 20% versus a 23% target. We may leave it there for a while and see how it goes. We may, sort of reduce exposure on strength if it rebounds a bit. Your operational cash, we continue to recommend you keeping about 6 to 9 months of liquidity on hand so that you're never liquidating into a weak bond or stock market to make monthly benefit payments. So your target is 1%. At the end of September, you were at 1.4, and we increased that. We sent some money to cash during this rebalancing in October. So at the end of October, you're up to 1.7% in cash. And we think that that's somewhere between 1.7 and 2% in operational cash gives you that cushion that we think is prudent. So as I mentioned at the onset of my asset allocation comments, there was a lot of money moving around in September and early October. The good news is that we don't have any rebalancing recommendations for this month. We will, the Baird bond fund, the core bond fund, is about halfway funded at this point in time. We funded them to the $8 million level. We probably want to take them up to $15 or $16 million. And we will continue to do that in coming months as opportunities present themselves. We will probably be trimming your multi-sector bond fund and high-yield bond fund exposure more to raise the credit quality and reduce the risk in the fixed income portfolio. We'll probably also trim your mortgage-oriented manager. And we may end up trimming, as I said, a little bit more from REITs or overweight equities, but we sort of want to see the impact of this market move that we've experienced in November before making further recommendations. But that's what the next couple of months might look like from an asset allocation and a rebalancing standpoint. So before I move on to performance of the investment teams, any questions on the asset allocation?
I don't see any.
Okay. Well, I was going to say when we funded Baird, I'll close off my asset allocation comments by saying when we funded Baird at the beginning of October and interest rates promptly went up another 30, 35 basis points during the month of October, the timing did not look really good. And now all of a sudden in the past 2 weeks, timing looks like it was genius, but that's just the way it goes with this crazy market that we're in. So hopefully interest rates are in the process of stabilizing. Okay, from a performance standpoint, I would ask you to turn to page 27 of the report, and that's where we're going to take a look at the performance of the total plan as well as your investment teams. So as I mentioned earlier, the total plan in the third quarter was down 2.9%, just slightly lagging the blended target index of minus 2.8%. You have 4 teams of managers that make up the total plan composite. Your fixed income team dropped also slightly more than target in the third quarter, down 2.2% versus down 2.1%. On a year-to-date basis, the fixed income team is clinging on to a slightly positive return as of September 30th, a lot more positive today. But you can see it, again, right in line with your target index of so 0.2 versus 0.3%. The domestic equity team dropped a little bit less than the blended target index for domestic equity in the third quarter, down 3.3% versus 3.9%. And let's see, the international equity team dropped a little bit more, down 3.6 versus 3.2%. On a year-to-date basis, the international team is well ahead of its target, up 8.1% versus 5.1%. And that actually is even higher than your domestic equity team. I think with everything going on in the world, geopolitically and economically, one wouldn't think that international and emerging markets would be outperforming U.S. markets. Now, that does include 2 global equity managers, so there's some domestic equity in there as well, but that served that composite well. And your real asset composite fell less than target, down 2.8% in the third quarter versus the target being down 3.8%. And it's slightly negative on a year-to-date basis. Year-to-date, your only team of managers that's behind target is the domestic equity team. And part of the reason for that is actually more of a benchmarking issue. Your plan, the investment managers in your plan, have a core to value bias. It's not that you don't have growth managers in your plan, you do, but you have more heavily weighted managers in the core and in the value side of the equation. And as Chris pointed out during his comments, in 2023 year-to-date, the value style has underperformed growth by a significant amount. We're talking, 20% difference in returns on a year-to-date basis between being in a value strategy and a growth strategy. So the benchmark for your domestic equity is reflecting more of a core to growth bias rather than a core to value bias. I'll just sort of, another thing I should have pointed out before I went over the performance composite is you'll notice there are some colors on this table, and it's color-coded. That's to, enable you at a glance to see how your plan is either over or underperforming its targets. So the more green you see on a page, the better. It means those teams, those strategies are outperforming the blended target index. The yellow means neutral to slight underperformance, and pink and red is underperformance. So you can see that your teams and the total plan are sort of in the neutral to slight outperformance, which is a good place to be. To take a look at some of the more individual manager performance, I would turn your attention to starting on page 31, and we will, we detail the teams, each of the teams, manager by manager. And I can certainly, walk you through all of those. I think I might just, in the interest of time, highlight, some of the either over or underperformers, and if anyone has any questions, I'm very happy to go into as much detail on any of these managers as you would like. So on page 31, we see your fixed income team. As of September 30th, you had 4 fixed income managers. Pinnacle is a core intermediate manager. TCW, Total Return, is a mortgage-oriented manager. Western Asset Income is a multi-sector bond fund, and Lord Abbett High Yield, as the name implies, is a high-yield bond manager. As of October, you now have a 5th manager, and that's Baird Aggregate. But through September 30th, you can see that your fixed income team was in a position where it slightly lagged, except for Pinnacle, that has been slightly ahead of their targets, and actually in positive territory on a year-to-date basis. TCW slightly behind the mortgage targets. Western Asset and Lord Abbett, they are behind their multi-sector and high-yield bond benchmarks, but they've actually been the best performing fixed income strategies in your plan on a year-to-date basis. As Chris mentioned earlier, high yield and bank loans, which is a securitized form of high yield bonds, have a much shorter duration, and with the credit markets holding up well, there's not been a lot of default risk this year, or actual defaults. So they have been your top performing bond strategies, up 3 to 3.5% on a year-to-date basis. So that exposure has been beneficial. As I mentioned, other than Pinnacle, TCW, Western, and Lord Abbett, all of those strategies will be getting trimmed back as we increase Baird's exposure going forward. On the next page, page 32, we see the domestic equity team. And here you see a lot of green on the screen, which is, goes to show you have a very strong equity team. If there is a weakness, it is the fact that you have a core to value bias as opposed to a core to growth bias. So Brandywine Global Dynamic Large Cap Value is one of your larger equity funds, and it's one of your weaker performers in absolute and in relative terms because of its deep value bias. Pinnacle is large cap. They have more of a core to a slight growth bias, which has served them well. You can see that they are your best performing domestic equity manager on a year-to-date basis, up 11.8%. You have 2 mid-cap managers, Harbor Mid-Cap Value and Janus Enterprise is Mid-Cap Growth. Harbor Mid-Cap Value has really been doing a great job in a weak category, mid-value, but consistently outperforming there. And Janus is doing pretty well at keeping up with mid-cap growth, which has been strong, not as strong as large-cap growth, but a nice place to be. And you have 2 small-cap managers. American Century Small Cap had a weak-ish third quarter of performance, but doing well in its category year-to-date and for the longer term. And then you have a small-cap growth ETF index fund, and that's performing in line, actually outperforming the small-cap growth index a little bit for the year. So good equity team. Again, hopefully the value bias will turn into more of a tailwind than headwind. But, I think you have a good equity team in place. If there are no questions on the equity team, I'll move on to international equity. Again, a lot of green on the screen, so you can see that as a team they're doing well, and even individually the managers are doing well. Janus Henderson Global Research does not invest in emerging markets, but does invest in global equities, meaning the U.S., Canada, and also developed markets. They're the top performing manager year to date for the plan, up 13.1%. They did drop a little bit further than target in the third quarter, but we're not overly concerned with that. American Funds Capital World Growth and Income is a more value-oriented global equity fund, and they are doing well also, but their value bias is holding them back a little bit versus Janus. Dodge & Cox International Stock is an international stock fund, invests only in developed and emerging markets, no U.S. exposure. They do have a value bias. As Chris mentioned, internationally, value has hung in there better than growth. It's a bigger sector, a bigger style internationally. And Dodge & Cox, as you can see from the color coding, just has done very well for the plan. And it's a good thing because they're one of your largest international managers. Invesco Developing Markets is your emerging markets fund. They had a weak third quarter of performance. They're still ahead on a year-to-date and a trailing one-year basis. And hopefully they'll sort of rebound in the fourth quarter and put up an even stronger full-year return. Your real assets team, as I mentioned earlier, has 4 managers: global REITs, two domestic REIT managers, and a commodities fund. And your domestic REIT managers, one is Cohen & Steers, which is on this page 33, and then on page 34, Principal Real Estate is your other. And they had a tough third quarter. It's been a tough year-to-date period for real estate managers, but both of these managers are holding up well within their space. And Prudential Global REIT Fund has been a manager for your plan for 10 years, and they fell less than the target in the third quarter and on a year-to-date basis. But again, internationally and globally, the global REIT market has also been a tough place to be. And done much better here in the month of November. Very welcome reprieve, so we're hoping to see much nicer numbers at year end. And your commodities fund is an index ETF, the S&P North American Natural Resources Index. Great third quarter, up 7.9% and up 4.5% year to date. So very much in line with the index. So that is, performance from sort of a high level and slightly lower level perspective. Any questions on your investment team or performance?
I don't think so.
Okay. I'll finish off by saying that for those of you that are interested and are looking for some really great reading material, on pages 47 to 90 of this report are fund fact sheets for all of your public mutual fund and ETF investments. So if you want a deeper dive into any of those strategies, it's really fascinating reading. Also on page 35, we show you manager watch list or status category. You have 2 managers that are on watch list status, and both of them are really more for personnel reasons. So TCW, Total Return, and Cohen & Steers Realty, the REIT fund, one of your domestic REIT fund managers, both of them have announced some senior management retirements that will be coming in 2024. So at Fiducient, that sort of flags us to take a closer look at those managers and keep a closer eye on them. We're not recommending any changes, but know that we're monitoring the situation, and we're going to be very vigilant to see whether or not performance is negatively impacted by any of the retirement changes. But in both of these firms, these are planned for transitions. Teams have been in place and managers have been co-managers on these strategies. So we're hoping for a smooth transition, but we'll be keeping an eye on things. And then lastly, I will say that on page 43 of the report, Chris mentioned when he went over the fiduciary due diligence calendar that we do keep an eye on fees. And while we do a deeper dive in like the first quarter of the year, on page 43, we present to you the management expense ratios of all of your underlying investments, and we estimate what the fee for the total, the investment management fee for the total plan is based on your allocation to those managers. So your estimated annual fee, investment management fee for running the plan is 55 basis points, a little over 0.5%. It's a pretty competitive number because your plan does not have a lot of index strategies. So, and index strategies tend to be lower cost than active strategies. So your active managers, they're priced quite in line with what industry averages are for their funds. I don't see any management fee here that's sort of out of line. So, but we will be doing a deeper dive in the first quarter and taking a look at those fees, and we're always keeping our eyes open to see if there is lower feed share classes that you might qualify for. You're pretty much in the lowest that we think you can be in, but we keep an eye on that. So I thank everybody for listening and for your time. I'm really hopeful that we're experiencing an early Santa Claus rally here in November. There's still a lot of time for the Grinch to swoop in between now and year end. But, you know, I think that, you know, we should end the year in pretty solid position, both in equity and fixed income markets. And then 2024, we start fresh.
Well, thank you very much, Natalka. Are there any questions for Natalka? No. Okay, well, I definitely hope November continues like it did yesterday then. Okay.
I know, it would be great. Well, you know, I'll remain in touch. I stay in touch with Jennifer and Erin on a monthly basis, and we'll take a look at, you know, rebalancing as I described it. But otherwise, I wish everybody a really happy holiday season, and look forward to meeting with you either in person or by conference call in February.
That sounds great. Happy Thanksgiving and Merry Christmas and Happy Holidays.
Thank you.
Happy Thanksgiving.
Thank you.
Okay. Bye now.
Bye. Is there any other business? Frida, do you have anything? Okay. All right. Well, we will adjourn the meeting then. Thank y'all.